Welcome back to the deep dive. We've just spent, well, a lot of time wading through more than 200 pages of corporate and sustainability reports.
A lot of pages.
Yeah. We're talking about the annual filings for a major publicly held utility. Our mission, as always, is to cut through all that, the technical jargon to get to the insights you actually need.
That's right. We are analyzing the 2022 operating year for this massive company. And it's a core utility, providing water and sewage services to 346 municipalities.
And it trades on the B3 exchange, level 2 corporate governance.
Mm-hmm.
Okay, let's just pause on that right away. For someone listening who isn't a specialist, what does being B3 level 2 actually mean for a company like this?
It's important. It signals a higher commitment to transparency and to protecting minority shareholder rights. So they're holding themselves to a higher standard, which is why we have these, very comprehensive documents to go through.
Got it.
Now, looking at the year itself, 2022 was anything but standard. The company's own management called it a year of exceptional circumstances.
Exceptional how? What does that mean?
It means you had all these simultaneous pressures just slamming into the operation at once. First, a multi-year water scarcity crisis. A really severe one.
Okay.
It was impacting the metropolitan area and over 3 million people. Then you had high global inflation, input costs spiking.
Right, the whole world was feeling that.
Exactly. Made worse by the geopolitical instability after the war in Ukraine. And then on top of all that, they were forced to adapt to this massive, sweeping new legal framework for the entire sanitation sector.
Wow. So that's a perfect storm of climate, finance, and regulation all at the same time.
A perfect storm is the right way to put it.
So given all that turbulence, how did the financials actually hold up? Did they manage to hold the line?
Well, operationally, they were actually pretty resilient. Net revenue grew strongly, up 9% compared to the year before.
9%. That's solid.
Very solid. That robust top-line growth shows that, demand for their core services is rock solid.
Okay, that sounds like a success story so far, but I know revenue never tells the whole story, especially in a regulated industry. So where was the pain felt?
The pain was strictly in profitability. It was all driven by those enormous cost pressures we mentioned. So we saw margin compression, and it was clear. Net income dropped slightly, down about 2%.
Okay, little dip.
But the really telling indicator was the EBITDA margin. That decreased by a hefty 4.5 percentage points.
Wait a minute, so even with 9% revenue growth on the top line, they lost 4.5 percentage points on their core margin.
That's right.
That suggests they just couldn't protect their bottom line.
Exactly. They were just absorbing the shocks. But here's the most critical figure of the whole year. What defined 2022 wasn't the profit struggle, it was the capital mandate. Investment surged 32.1%.
32%.
Reaching a massive $1.7 billion. That number, that spike in capital spending, that really tells the true strategic story of the year.
Okay, that is the headline. An investment spike of over a third. So let's dive into those headwinds driving the costs. What were the top challenges?
We have to start with the most immediate threat. So challenge number one, the multi-year water scarcity crisis, which was really hitting the Curitiba metropolitan area hard. This wasn't just, low water levels. This was a severe ongoing emergency.
And their response went beyond just typical crisis management, right? I remember reading about some almost futuristic steps they took.
They absolutely did. I mean, of course, they expedited critical river transfer projects to get more physical supply immediately. But the real headline response was their deployment of cloud seeding technology.
Cloud seeding? You're cheating.
It sounds like a sci-fi novel, I know. But this measure alone was credited with adding over 11 billion liters of water to those critical basins right at the height of the crisis.
That is fascinating. That's climate adaptation in real time.
Exactly.
Okay, so challenge one was survival. Challenge two sounds like it was all about the future, that mandatory regulatory shift.
It was. Challenge number two was implementing the new legal framework for sanitation. This law is a complete game changer. It mandated these incredibly aggressive universalization targets.
Which were what exactly?
99% urban water supply and 90% urban sewage collection and treatment, all by 2033.
Wow.
And that immediately meant they had to prove they had the economic and financial capacity to actually do it.
That's a huge burden of proof. Operationally and financially, how do they even structure themselves to meet that mandate, like overnight?
Their response was structural, and it was contractual. So they formally adapted and updated 331 service contracts by March of 2022. And crucially, they restructured their own governance around three new regional entities they call microregions.
Microregions. Is that just a new way of reporting, or is there more to it?
No, it's far more strategic than that. This structure, it effectively decentralizes accountability. It lets them manage very specific regional investment plans and performance indicators, all tied back to that 2033 mandate. It basically locks in the framework for future accountability.
That makes sense. Okay, so finally, let's go back to that economic pressure cooker that caused the 4.5-point margin drop.
Challenge 3. The rampant inflationary and supply chain shocks. This hit them really hard. Material costs, especially for essential treatment chemicals, jumped a staggering 32.6%.
32%.
And at the same time, personnel costs rose 17%.
And this is the critical context, right? In a regulated world like this one, when your input costs jump by a third, you can't just raise prices for your customers tomorrow.
You can.
You have to eat that cost shock until the next regulatory review cycle. That's what forced that compression.
Precisely. It shows their operational strength, but it also highlights the intense financial strain of these, shocks from the outside world when you're in a tightly regulated market.
Okay, so let's pivot from reacting to challenges to actively driving strategy. We know investment hit $1.7 billion. What were the key events that tell us where this company is actually headed?
I think the first key event is a major capital structure move, and it's fundamentally tied to ESG principles. The company raised $600 million through a debenture issue that was explicitly certified as green and social bonds.
Right. Sustainable finance funding core infrastructure.
Mhm.
But you have to ask, are green bonds really effective here, or is this just good PR masking standard debt?
In this case, I'd say the impact is measurable, and it's completely aligned with their mandate. The debt was aligned with the UN Sustainable Development Goals, 3, 6, and 11.
Okay.
And just look at where the money went. Sewage infrastructure received the single biggest investment increase, jumping 53.9%. This green bond financing directly funneled low-cost capital into that urgent 2033 universalization push.
So ESG financing is actively driving the core public mandate. Okay, next up, let's talk about efficiency. That whole idea of turning waste into revenue.
Yeah.
What was the big innovation there?
That would be key event number 2. This accelerated innovation in sludge management. They really pushed forward construction of a high-capacity sludge thermal drying system at one of their main treatment plants.
A thermal drying system. So what's the benefit of just drying sludge with heat?
Well, it's transformative for their efficiency. The system is designed to use biogas that's produced right there at the plant as its fuel, and it reduces sludge moisture from, say, 80% all the way down to just 20%.
And the impact of that?
The massive impact is that reduces the final volume of material that needs disposal by over 90%.
90%.
Which means the company is transitioning away from relying on costly sanitary landfills for its largest waste product. It's a huge step.
That's a massive move toward a real circular economy. Okay, finally, on the governance side, there was a commitment to cleaning up their internal structures.
Yes. Key event number 3 was a major corporate integrity and governance overhaul. They revised and strengthened their integrity program and formally added 2 new ESG pillars, diversity and, critically, third parties.
Third parties, so that's about their supply chain, anti-corruption.
Exactly. It aligns them with new regulations, specifically CVM Resolution 592022.
Yeah.
So they're not just focusing on their own staff, but on everyone they do business with, their suppliers, their external partners.
And how are they tracking that?
They implemented a new dedicated software system for governance, risk, and compliance, a GRC system, to measure all this. So they are institutionalizing ESG risk right into their software, showing a really proactive and, measurable response.
Excellent. Let's move into the dedicated ESG section then. Starting with environmental, which makes sense given the climate risks they just navigated.
On the E front, they're continuing to scale that waste-to-energy model. So highlight 1 is the consolidated operation of CS Bioenergia. They hold a 40% interest, and it's generating 2.8 megawatts of clean energy from treating sewage, sludge, and organic waste. That is implementation at scale.
Okay, that's what they're doing now. What about that forward-looking climate adaptation investment you mentioned?
Right. Highlight number 2 is the commitment to nature-based solutions, or NBS. They approved $87.63 million over 10 years to convert old mineral extraction pits into, dilution wetlands and natural reservoir.
Nature-based solutions. That sounds fantastic for long-term resilience, but a 10-year timeline for converting old pits into wetlands? That sounds incredibly complex. What are the risks?
The report is actually pretty explicit about that. It notes that this project relies heavily on the success of very complex multi-party agreements and long-term planning. The funds are allocated, so the commitment is there, but that interinstitutional execution risk is the major hurdle.
Got it. Okay, moving to social, the S.
Right.
For utility, access, and affordability are everything.
And here they made a huge move. They executed a massive expansion of their social tariff program, the Agua Solidaria program. They increased coverage by nearly 81,000 low-income families.
So what's the total now?
They're now serving over 300,000 families in total, and the total financial benefit granted was huge, $210 million. It's about ensuring critical access during really tough economic times.
And what about internally? The workforce.
Workforce engagement seems strong. Employee satisfaction hit 77.45%, which actually beat their internal target. And they formalized flexibility, offering remote or reduced hours to about 10% of their workforce. Pretty modern for a traditional utility.
It is. Okay, finally, governance, the G. We talked about the compliance overhaul, but let's address the elephant in the room, diversity. What did the report say about representation?
This is where there's a material gap. Despite creating a new diversity committee, the metrics across their governance bodies are still heavily skewed. The report states 84% male representation overall.
84%.
And critically, at the highest levels, the board of directors and the executive board, it's 100% white.
Wow. That is a stark material gap, especially at the strategic decision-making level. What did the company say about that? I mean, especially since they just created that committee.
Well, they acknowledge the need for improvement, and they point to the committee as the mechanism for change. But the data confirms that structural change just hasn't reached the executive and board levels yet. It shows a commitment to future goals, but a clear failure to meet modern expectations for diversity right now.
That's a crucial observation.
Yeah.
Okay, let's shift our focus to the future, the stated objectives and priorities for the next cycle.
Right. So priority one is just relentless execution. It's all about universalization and capital deployment. This is the single most critical strategic focus for them. They have to maintain that massive investment pace we saw, that 32% growth, to hit those 2033 targets.
And success for all of that hinges on what exactly?
The success of the public-private partnership, the PPP that they're modeling for their Center Coast microregion, that deal is in the final administrative steps. If it succeeds, it will really accelerate everything.
I'm most interested in the future revenue. You mentioned green innovation. What's priority two?
Priority two is highly ambitious, driving accessory revenue through green innovation. They are actively funding some pretty advanced R&D projects set to launch in 2023.
Like what?
Like a $12 million joint project for renewable hydrogen production from biogas, which would be a first in the country, and an $8 million experimental project for biomethane production and marketing.
So they are trying to turn what was basically an operating cost treating biogas into a high-value investment revenue stream.
That is the core goal. Monetize waste streams to generate that accessory revenue, which could help stabilize their finances against that tough regulated cost structure.
Okay, and finally, priority three. This one addresses metrics and climate management.
This one is critical for their long-term planning, formalizing climate and innovation management. So they're rolling out a new corporate innovation platform and, crucially, committing to implementing internal carbon pricing and building something called a marginal abatement cost curve, or an MACC.
Okay, hold on. A MACC. Can you break that down for us? What is that, and why is it so important for their financial decisions?
MACC is basically an internal ranking system. It lets them scientifically prioritize all their greenhouse gas reduction strategies based on the cost effectiveness per ton of carbon saved.
So it connects the environmental goals directly to the budget.
Exactly. It moves climate goals from just a qualitative concept to a measurable, budgeted reality. It's how they'll decide where to put their money to get the biggest environmental bang for their buck.
This has been a true deep dive into an organization under immense pressure. Let's finish with the essential takeaways for anyone following this sector. What are the three most important insights?
Insight number one has to be resilience in investment over profit. 2022 confirmed that the mandatory regulatory pressure to invest, that 32% jump, completely dominated their financial outcomes.
Right.
That 4.5 percentage point drop in the EBITDA margin shows the immediate cost of compliance and fighting inflation in a price-regulated world.
So investment mandates are driving strategy over short-term profit. What's insight two?
Mandatory universalization is the primary strategic driver. I mean, every major decision, the capital surge, the grain bond financing, restructuring into microregions, it all flows directly from that new legal framework. The 2033 target is the single biggest factor influencing their capital allocation today.
And the future secret weapon.
Insight number 3. Innovation is being institutionalized for efficiency and revenue. They're scaling real, tangible solutions, that thermal sludge drying system, green bonds, the hydrogen R&D. These aren't just pilot projects. They're aimed at materially improving efficiency while strategically seeking new revenue.
This deep dive really shows a utility wrestling with extreme climate and economic turbulence while trying to meet these huge public mandates. But two tension points remain for you, the listener, to consider. First,
Okay.
the company nailed water quality at 99.91% conformity, which is great. Yet the system still records staggering physical losses, 222.67 liters lost per connection per day. So the question is, can the massive investment required for expansion be balanced with the urgent need to drive down losses and improve efficiency?
That is the crucial operational tension. And the second question builds on their green innovation budget. Given the ambition, how quickly can those R&D projects in hydrogen and biomethane convert from experimental budgets, those 12 million and 8 million commitments, into substantial, reliable revenue streams that actually offset the regulated cost structure?
That balance between efficiency and expansion and the leap from R&D to dependable revenue, that will define their performance for years to come. Thank you for walking us through these reports. It really distilled the critical context.
My pleasure. Analyzing these comprehensive reports is really the only way to get the full strategic picture beyond just the basic financial statements.
Absolutely. Thank you for joining us for another deep dive. We'll see you next time.